Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The U.S. currency started the week by hitting three-year lows against a basket of key currencies, but soon closed the gap on DXY, rising from 97.7 to 99.7. However, the upward trend has not yet developed. Unresolved trade disputes between the U.S. and China continue to undermine the U.S. currency's position, creating impulses for a simultaneous sell-off in USD, equities, and bonds. We saw positive traction when markets received assurances that Trump would not fire Powell. But we also continue to note the Fed's rather hawkish rhetoric. Open market committee members are openly saying they will not rush to cut rates and are wary of the impact of tariffs on inflation. That said, interest rate futures give a more than 50% chance of 4. That's a marked shift from 2 to 3 cuts a month earlier, which underlies the current dollar weakness. It's a worrying bet that Powell will have to pull the economy out of recession at the end of the year. Technical analysis suggests an increased chance of a corrective bounce since the start of the year, as there is consolidation after the failure. At the same time, historical data previously showed that after the rebound, one should be ready for a new wave of decline in the U.S. currency. Financial markets are gradually pulling back from the shocks of recent weeks, including the tariff clash and attempts on the Fed's independence. While these stories promise to return more than once in sight, market participants are gradually realizing that the point of maximum uncertainty is over. Sentiment in the stock markets has moved into fear territory, with the Fear and Greed Index at 27. This is 24 points above the lows of 8th April and fits the typical recovery pattern after a bottom. Stock indices have yet to boast a similarly impressive recovery, adding about 2% on the S&P 500 since the start of the week, still pinned at local resistance at 5,500. The index remains near the resistance line of the downtrend that has been in place since late February. Barring politics, it is more favorable to be on the bullish side right now as the market recovers from the correction. However, in the real world, the puzzle is more complicated. The Fed is not changing its hawkish rhetoric, as it has done in previous episodes of similar sell-offs. Tariff disputes continue with no apparent breakthroughs, and the news itself is highly contradictory, which hurts business. We therefore anticipate a very uneven and protracted upside, and buying on news-sparked sell-offs could be a working strategy for many weeks to come. Gold's 5% rally in the first 30 hours of the trading week, and touching the important round level of $3,500, was followed by a steep fall to $3,260 in the next 30 hours. After that, the price stabilized at $3,340, close to the highs of the previous week. Signs of a head and shoulders pattern are forming on the charts. In case of a new decline under $3,300, we may witness the acceleration of profit-taking. It may be a sell-off after a dizzying rally, with the potential to go below $3,000, mirroring early April's growth. The long-term technical picture points to continued overheating and elevated correction potential. An alternative medium-term scenario is that the massive decline has already cleared the way for a new wave of gains. The news on tariffs and geopolitical tensions has enough power to override the entire technical picture. Silver is moving asynchronously to gold. It has almost managed to climb out of the hole it fell into in early April. This return to the highs of October 2024 and March 2025 is of great significance. From around this area near $34, we also saw a reversal in 2012, after which the price lost 60% in the following 3 years. The cryptocurrency market has corrected about 1.3% to $2.9 trillion from Wednesday's peak, but has been steadily adding over 8.5% over the past 7 days. The market is bouncing off the long-term key level of $2.5 trillion, which previously acted as a significant area of resistance. Capitalization has surpassed the recent peak, marking the breakdown of the downward resistance of the last 3 months. This is an important signal of the market's willingness to move further upwards. Bitcoin was climbing towards the 94,000 area during the week, more than 20,000 above the low point at the start of April. Reaching the recent highs aligned perfectly with the 161.8% Fibonacci extension from the initial bounce, fitting neatly into the pattern. At the same time, it suggests a new short-term consolidation phase before an upward spurt. The technical target for a potential new rise is at 106,000, which is near the area of the first cryptocurrency's historical highs. If the Fibonacci pattern works, we will see a third test of these levels. The new week has the potential to return markets' focus from geopolitics to macroeconomics, although it will start with reactions to the Canadian election. On Tuesday, the focus is on Germany's April inflation figures. It has been just above the target 2% for the last few months. But without it accelerating, the ECB may continue to ease policy. Wednesday will see the release of China's PMI business activity data. The reading has been in neutral territory lately. investors and traders will be closely watching businesses' reactions to the dramatic developments around tariffs. The Bank of Japan will announce its rate decision on Thursday morning. While no changes are expected following last month's significant rate hike, any shift in tone could still influence the yen. On Friday, the main blockbuster will be the monthly U.S. labor market data, which analysts and traders will piece together to assess what actions businesses are already taking and whether the announced tariffs are a shock to the economy. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.